So my name is Arun Lakhiani. I'd just like to introduce myself before we get started. I'm a partner at Norton Capital. We're based out of India, and we provide fund management services for clients worldwide. Today's topic, the last two webinars that I had earlier last month and the month before that, was more on the technical side of trading, as well as the pivot points and Fibonacci. So this month I'd like to touch, get more into detail about the fundamental side. I've always mentioned to the people that I've spoken to about Forex is, trading purely on technicals or purely on fundamentals, generally, you won't be very successful in the long run. So you do need a bit of both. And, that's why I'm touching upon this topic today. So I know a lot of you do read the fundamentals every day, news that comes out every day on FX Trade or whichever other websites that you're using. Why and how central banks needed. Does anybody know what the main purpose of a central bank is, of any? Right. So I guess I see play with interest. Well, I'll give inflation, all right. These are all, yes, they do play a big part in an economy. But the main purpose, I'll give you a hint. We use it every day in our lives, and we wish we had a lot of it. Anybody? I'll give you a few more. Yes, currency. Well, the main role of a central bank is to print notes. That is their main mandate. Interest rates, inflation, yes, that is all part of what they need to stabilize in an economy. But the main role of a central bank in any country is to actually print notes, because you cannot allow a private bank or even a public bank to print notes for the whole economy. It has to be the central bank. It has to be one authority over everything, and even if a government has to borrow, it has to borrow from the central bank. So that is the main purpose behind central bank. I'd like to touch upon the major changes that occurred and why central banks are behaving in this sort of fashion in the last couple of years. A lot of you have heard about QE, printing money, inflation is very low. And, basically, if you look at the Fed and you look at and the Bank of England, they're printing money to actually increase inflation. So why this actually happened was, if you look at the first Great Depression in 1929, at that point of time, central banks were they were the exact opposite of being proactive. So they expected that each economy has its own cycle, and the cycle would take, depending if it's a long-term trend, it will probably take between 5 and 10 years from an economy that's progressing rapidly, and then it slowly, it's like a cycle. So they all thought that at that point of time that, it's a cycle, and there's no need for the central bank to actually intervene in any depression or any stage of slow economic development. But after 1929, most central banks realized that they can actually move around and be proactive and start moving things moving the interest rates and printing money in different ways, so they can actually affect market volatility and market stability. The reason why 1929 happened, there are a lot of people and they have a lot of opinions about why 1929, the Great Depression that happened in 1929. A lot of people say that it occurred due to the stock market crash. But there's always a reason behind the stock market crash. A lot of people are talking about in the current scenario where, most markets around the world are at their all-time highs. If you look at the Indian markets, it's already crossed their all-time high. Of course, the US markets are breaking records every day. So, there's always these pessimistic analysts who expect that, who at least forecast that in the next few months, there will be a big correction. But in 1929, this correction was just not a correction, it was disaster. And this occurred due to people actually getting scared. So when there's no stability in a market and the central bank's not being proactive, people actually go to their banks, go to their ATMs and start withdrawing money. And even if a particular bank is not in danger, it will be put in danger because people are actually withdrawing all their funds. So if one bank has been affected by maybe a downturn in economic development, it actually spreads towards different banks because people, once they hear it in the news, it just, people get actually scared and they start withdrawing everything that they need to. And at that point of time, 80, 90 years ago, there was no real, well, if you look at this scenario in today's day and age, communication is everything. If something happens in the US, it triggers a worldwide effect. At that point of time, it was just the US. And of course, it did feed off to other countries, but it was in a slow and in a very slow manner. Now, what happens if there's a huge downturn in economic development in one nation? It's going to affect many, many more nations. And that's why central banks are much more careful, and they don't want even 2000 to reoccur again. And a lot of people are saying that if 2000 occurs this time, it's going to be much worse than 2008. Are we clear till now? I mean, I'm sure all of you understand the fundamentals behind central bank policies. So we're going to go a little bit deeper. I've just created a table for you guys. So I'm going to switch over to this particular table. So just give me a minute. Yeah, so can all of you see this Excel sheet that I've prepared clearly? Okay. All right. Okay, great. So it's a very basic spreadsheet. It's the current interest rates for all major economies in the world. So I've included 7, being Europe, America, New Zealand, Australia, Japan, Canada, and United Kingdom. And if you look at the last column of the table, I have prepared what I think will happen in the near future with interest rates. Now, does anybody understand how interest rates work and what the effect is with their own currency? I'll explain this now. For example, if Europe the ECB were to say decrease their current interest rate from 0.25% to 0%, and anybody know what would happen to Euro USD? Yeah. And does everybody know why? Yeah, correct. So spot on, FX ready on. So basically, if I was sitting in another country, and well, these rates are actually rates between interbank rates. They're not actually lending to the public rate. There is a difference. They might differ a little bit here and there. So, for example, if I were to put my money in Europe, my yield would be, if I would take it at this spread and the zero spread, it would be at 0.25%. Now, if that same money is kept and they reduce their interest rates to 0, I will not be making any money on my deposits, literally. Now, if I were to rather take my money and put it in New Zealand and in any of their banks, my yield would be 2 and 3/4%. It's quite obvious where I would want to put my money. I'd rather put my money in New Zealand. Simple. So the yield is much higher in New Zealand. But there is a catch to just blindly putting your money in a country where the interest rates are high. Interest rates in India are 6 or 7%, or they on a fixed deposit it goes to about 9%. But a lot of people don't realize that even if the interest rates are high, inflation is very high in that particular country as well. So if you're putting your money into a particular country, you are getting your 8 or whatever percentage you're looking at. But if the inflation is more than your interest rates or your yield, then you're actually not making anything. So for example, if New Zealand's inflation rate is 3% and they're giving you, a 3% interest rate on any funds that you put into any of their banks, you're actually making 0. Are we clear? All right, so I'm going to move on. So I'm going to look at ECB first. Uh, well, as per Mario Draghi's last meeting that he had a couple of weeks ago, he gave us a fair idea of what's expected to happen. But what I've been seeing with ECB meetings in the last year and a half, they haven't really done much. They've just said a lot of things, but they haven't really gone ahead with any of them. They've mentioned that if inflation ticks down by maybe 10 basis points or 20 basis points, they're going to restart I mean, they have many tools. One of them would be reducing interest rates. The other one would be, of course, their own form of QE. So these are the two things that they would look at. I don't see anything. I've been talking about de-sterilizing that program. Does everybody understand what the difference between Fed's QE program and the ECB's monetary program currently? Okay. I'm getting only a yes from one person. So I'm going to explain this anyways. All right. So I'll speak about Fed's QE program. Okay. Okay. So I'm guessing it's probably your system. Sound seems to be okay with everybody else. All right. So the difference between Fed's QE program and the ECB's program is Fed. What they're doing is they're buying government bonds, but they're actually printing a new supply of money while actually purchasing new bonds. Now, for example, their current $55 billion QE program currently as of this month, what they're doing is they're actually going out printing $55 billion notes, and they're actually purchasing $55 billion worth of government bonds. That's what they're doing, right? So it's quite obvious. The more you supply a currency, the value of it goes down. So, and the exact opposite is happening in England. In Europe. What they're doing is they've said that if any nation within the Eurozone applies for the OMT program, what they're going to do is they're going to strip that money out of the system and then provide that same supply that's in trouble. So, yet program yet a lot of conditions that the ECB has applied for told these nations that they have to undergo and for them to actually go ahead with the OMT program. So no one's actually done it yet. But even if they go ahead with an OMT program, if they don't sterilize it, if it's sterilized, then it's not going to really make a huge impact on the Euro USD. If they do come out saying that, okay, we're going to follow what the Fed's doing, you will see the Euro tank. All right. So I've just cleared off America's the QE program, and as per their last meeting, Janet Yellen did mention that they'd like to see interest rates higher in mid-2015. So this is not my forecast; it's actually been said. But there are people within the Fed who, no, I didn't say up. I said tank. Euro going down. So just to make it clear here, if the ECB does de-sterilize their program, you will see the euro tank. But that's not expected to happen anytime soon. It doesn't look like it's going to happen. The fundamentals, the numbers that have come out from the euro have been slightly on the higher side, better than forecast at least. Okay, so de-sterilize. So I mentioned that when ECB does intend to provide, a helping hand to a nation, they intend to strip that same money out of the supply, of the current supply of in the system. So that is actually sterilizing. That's called sterilizing. And de-sterilizing would mean exactly what the Fed is doing. Clear? So the de-sterilizing would mean that they're actually printing. All right. Okay, so I'll move on to the next one. So it's pretty simple. Fed is expected to increase their rates in mid of 2015. This Well, the thing is, the markets are very dynamic. So what the central bank says now may not actually happen in the near future or in long term because there are a lot of market forces that play, their part. So it's always important to look at your chart as well and to look at technicals and just by what they don't go by just by what they're saying to you. So for example, if the ECB says we're going to reduce our interest rates by 10 basis points, that doesn't mean you sell euro USD at that point in time. If they're saying we're going to. All right, so I've got a question from Alexandro Emilian. All right, so how about the basic fundamental dynamic that says risk on currencies go up during growth periods? Aren't we in a growth period with stocks going up and so on? So it's normal to see euro go up as it's a risk currency. All right, just to make it clear, euro is not really considered a risk currency. If you compare euro with New Zealand dollar and Australian dollar, these are considered risk currencies because the interest rates are really high. Even the Canadian dollar is considered more of a currency compared to the euro. All right. So it's always been a fact that the Japanese yen and the American dollar have always been the safe havens, so to say. But that's changing at least with the Japanese yen. If you see a downturn in at least the Japanese markets, where there was a correction of about 7 to 8% last month, there was hardly a move in the Japanese yen, maybe 0.5%. So it's not the same as it used to be maybe 3 or 4 years ago with the Japanese yen, but yes, the US dollar is still considered a safe haven. Europe, it's a very different picture with Europe. It's a lot of people think that okay, it's a risk-on currency, but it's not. It's just that their economy is actually improving when a lot of people didn't expect it to improve. So a lot of people are still negative about the euro, and they're still not out of the slump. In fact, Mario Draghi keeps saying that they're not out of the woods yet. But the numbers keep coming out, and they're actually positive most of the time, except the confidence. If you look at German confidence that came out yesterday or the day before, they were actually negative. So I wouldn't say the euro is considered a risk-on currency. It's just I mean, if you look at the average of the last 4 or 5 years before 2000, the last maybe a year or two before 2008, the euro was actually trading at above 1.5. So even if we're trading at 1.4 or 1.45, it's still below the 2008 levels. But yes, it makes a huge difference to the central bank when they see a strong currency. Most central banks don't like their own currencies being very strong. I'll get into that in a bit. But let's move on to the next region, that's New Zealand. New Zealand, that's all right. So this is the RBNZ. They just hiked their interest rates by 0.25% was it this month? Yeah, I think it was this beginning of this month. So I've mentioned that in the last column, they're rapidly expected to increase interest rates by at least 50 basis points by this year end. This also it's been clear. Okay, I've got a question. What will be the effect of the numbers on USD if the GDP and unemployment claims are green? Well, there are two things to look at when numbers are coming out of the US. Firstly, as earlier Alexandra mentioned that we're in a risk-on environment currently, and when we're in a risk-on environment, there's not much demand for a safe haven. So it's like saying that okay, the numbers coming out of the US are strong. I should be buying US dollar, but at the same time, we're in a risk-on environment, and there's no demand for the US dollar. So the real impact now is QE. If they consider or continue to taper, eventually it'll be at zero, and they increase their interest rates, that's when you're going to see a huge demand for the US dollar. Currently, if you look at the balance sheet of the US and other major economies, they're still very, very high. They're up almost at the top, apart from the Japanese Bank of Japan. So, even if we were to stay at these levels at 1.37 or 1.8 for the next 3 or 4 months, it's not going to really make a difference to most central banks, even ECB. They're seeing the numbers that are coming out from their own economy, and they're happy with it. And they look at this number and they say, okay, we're in progress. Compared to last year where everything was declining, Greece was in turmoil, Cyprus was also in turmoil, and there were a lot of stuff that was going on. But if you look at this year, everything's been smooth, apart from the crisis, the Ukrainian crisis that's going on. But I'll get into that as well in a bit. All right. So New Zealand, pretty clear. Their interest rates are expected to go to maybe about 3.5, 3.25, 3.5% by end of this year. So my expectation for New Zealand dollar against the USD at least would still be very bullish. Maybe it's already touching 0.87. I would expect maybe 0.8750, 0.88, maybe stabilizing around there for a bit. Maybe see a correction again. When they do increase, you'll see 0.88 again. So, if anybody is looking to buy US dollar, this would be the worst currency to buy the US dollar against, because you're paying a negative swap as well. So you're holding your trade. If you're in loss, you'll be paying 2.75% minus 0.25%. That's 2.5% on your trade on a year. All right. So let's move on to the next country. That's Australia. Reserve Bank of Australia. Well, this, I like what they've done in the last few months. All right. So they've reduced their interest rates a couple of times. And they've really downplayed. They've handled their currency very well, I would say. A lot of. If you look at ECB, and a lot of people a lot of countries within the ECB want the euro lower, but they're not doing anything about it. Australia's stepped in, and they've not really done any QE program as such. They've actually this is standard monetary policy, and they've just talked down their currency, and they've gained the Australian dollar's lost about 15% if you look at it from last year. So if you look at how much they've put in to actually reduce their currency strength and the impact of what they've done, Australia has they're by far the most efficient central bank compared to all of these. And if you look at Japan, they've been in deflation for a decade, or almost 2 decades. So they had to really do something drastic now. There was a QE program from 2001 to 2006, but that didn't really make a huge impact. So now their bond program is huge. All right. So a lot of analysts expected the USD Japanese yen to peak out at 110. Peaked out at 110, 105.70 or 105.50. I don't see it going, higher than that in the near future. Even if they do increase their QE program, I don't see it going much beyond that figure. Mainly due to the fact that we are in a risk-on environment. Japan is actually pumping money into the system. This is all actually happening, and we're only seeing USD Japanese yen at 102. So that doesn't look very good for the yen. I mean, I would expect the yen to actually strengthen in the next few months, even if the BOJ says, or they keep saying that we're going to keep the interest rates here, we're going to boost inflation, we're going to do this, we're going to do that. No matter what, I don't see USD Japanese yen crossing 105 or 106 at the top. That's at least for the next 6 months. So that's it for Japan. Let's move on to Canada. Bank of Canada, current rate is 1%. Well, they haven't done much either. They've well, the numbers that came out of Canada for the last 6 months have not been great either. And they benefited a lot with the US's QE program, purely due to the fact that they're so close to the US. US dollar, Canadian dollar has actually skyrocketed, making the Canadian dollar very weak against the US dollar. So that actually works out very well for the economy. So we should be seeing some good numbers coming out of Canada, purely due to the fact of their weakened currency. So at least the next couple of quarters, we'll see some good retail sales. We'll start seeing some good GDP growth, inflation, everything. Once that starts happening, you'll start seeing the Canadian dollar actually strengthening against the US dollar. All right. Now, the last but not least is the Bank of England. Their rates have stayed the same for about 4 years. They also do have a large QE program, which is also expected to be tapered. I feel that they will do the same as the Fed's doing. They will taper at a very slow pace. But my worry is GBP USD is at, say, 1.6. levels right now, and they're not happy with it either. If they do start tapering, and already expected that they're going to increase their rates in 2015, and if U.S. doesn't really stick to their plan of increasing their rates in 2015, GBP USD will cross 1.7. The correction that you saw in the last couple of days is still part of the bigger picture in which the GBP is still expected to strengthen. So going long against the GBP, going long with the GBP would still be a good trade to take, but of course looking at your technicals as well. So I've just cleared all the major central bank interest rates and what they're expected to do with their interest rates. So now I'm going to switch back to my MT4. And here we go. Can everybody see this clearly? All right. All right. All right. So I'm going to start with the ECB right now. I've already mentioned a couple of things about what they're expected to do, but this is a little bit, I'd like to go a little bit more in detail. Well, in the last year or so, there's not been much mention of easing of any sort. There's only been a constant mention of considering all options. That's been his usual statement, and the statement that's coming out of ECB. So in the beginning, say second quarter or third quarter of last year, 2013, a lot of traders were breaking their heads on why the euro is going up so much. It was very clear at that point of time that their balance sheet was actually contracting. Fed's balance sheet was not, it was plain and simple. Again, even post that, the numbers that are coming out of Europe and the US were both pretty negative in 2013, no matter what. So it was, again, purely based on yields and, of course, on their balance sheet. And that's the reason why it reached 1.38 or 1.39 and almost touched 1.4. Even after the QE taper was decided, and when they went ahead with it, and they've already reduced 30 billion. But, it does take time, as in when a central bank says they're going to do something and it actually does happen. So, for example, in December, when the Fed decided, okay, we're going to start tapering, the actual reduction of the 10 billion actually happened in Jan. So it was a month away. But I'm not saying that people don't expect this to happen, and you do need to trade based on market expectations. A lot of people, or the markets are, all the movement is based on expectations about what's happening or what's going to happen in the future. So everybody still already knows that the taper is going to end up being at zero. I mean, the QE program is going to end. So, why is the euro still at these levels? It's still not 100% confirmed that the US Fed is expected to cut 10 billion for another 5 more months. Anything could happen in the next couple of months that would completely turn the direction of what they intend to do. But as of now, it looks like, yes, they are going to taper every month on month, until, QE is actually ended, QE3 is finished. All right. But at the same time, we are in a risk-on environment, as I mentioned earlier. So there's a lot of dynamics in what's going on. So you cannot go by their word and say, okay, we're stopping we're stopping our QE program, let's just sell euro. That's not the right way to go. There's a lot of other things that you need to look at. And, your technicals, of course, are very important as well. All right. So the other things that they've mentioned, of course, another important point to note is that the inflation is currently running at 0.8%, which was an uptick to the rate that was mentioned, I think, in January. So it was 0.7%. That's when everybody kind of got scared and they realized that, okay, maybe the ECB might come into action and come in full force and, start a QE program, but it didn't happen. And, there was an uptick in inflation, and once there's an uptick in inflation, everything's back to normal. Everybody expects, inflation to pick up next month and the month after that, and, it'll soon go to 1.1 or 1.2%. So as of now, everybody's happy, risk on environment, everything's going well. Stock markets are roaring, raring to go every day. So it's all good. Well, if you look at the ECB, there's not much room to cut interest rates, so they can only go back to zero. So they're at 0.25 right now. A negative interest rate would not bode well for the ECB and the eurozone. People have kind of put away what happened 2 or 3 years ago with the euro, and it's still fresh in their minds. So if they actually have a negative interest rate, they'd rather put their funds in, I would guess, the Swiss franc. That would be the closest where they would like to put their funds, even though they already have negative interest rates. It's a much safer option. I got a question. Can they do 0.10 before 0.05? Yes, they can, but there's only so much they can do. Generally, when we see a central bank reducing their interest rate, it's mostly 25 basis points. So if they do reduce their interest rates by 10 basis points or 5 basis points, it's not really going to make much of a difference. So what they would like to see is spur an economic. They're not looking at their currency as such. They're looking at economic development and money going into new industries and businesses, so things can get back into shape. They're not really looking at the euro as such. So if they were to reduce by 0.1%, that's why they haven't really done it yet, because they realize that if they were to bring their interest rates down to 0.1, the effect that's going to have is not worth them actually reducing it to that level. All right. So let's move on to the Fed. Everybody knows Janet Yellen's come into the picture after Ben Bernanke, and before she came in, everybody expected her to be much more, her monetary policy, or at least her vision of what they expected her to do when it comes to monetary policy was much easier compared to Ben Bernanke. Although Ben Bernanke is also considered a dove, Janet Yellen was considered a dove's dove. She was extremely dovish in the last couple of years in office, and everybody expected her to continue, but it was actually the opposite when she came in. She's considered to be very hawkish. Her first few statements in office also were quite hawkish compared to what they expected. So that was a very big surprise for the markets, and everything that she's done is as per her timeline. She's not really done much to not follow her timeline. Whatever they've said in the last 6 months, or at least 4 months, Ben Bernanke, they followed it. So I see no deviation from what they're actually doing, at least in the next quarter. All right. So, but it's also important to note that it's not just one person. It's not just Mario Draghi, or it's not just Janet Yellen that's there to that's going to decide the fate of a central bank. It's a group of people who actually vote. So it's important to understand the members of that constitute a particular central bank. Okay, I've got a question. Hawkish is QE. Hawkish, no, that doesn't mean QE. Hawkish would mean that they're very positive, or they're very, if you look at the ECB, considering what they're actually saying and where their economy is, I would still say they are very hawkish. Hawkish would mean that they're very positive on the economic developments, and if they were to taper, or if the Fed were to taper, that would be a hawkish statement. A dovish statement would be, no, we'd like to increase our QE to 100 billion or 120 billion. That's very dovish. So that's being very negative, and they're expecting for much longer to improve or to actually get into the green. All right, we clear? A couple of big important points to note. Well, yes, dovish does mean QE. I mean, dovish just means that it's a very general term. So QE may not be a part of being dovish. Dovish would just mean that they'd like to keep their interest rates very low. They'd like to do whatever they can to spur economic development. That is all being dovish. All right. So QE may or may not be a part of a dovish statement. All right. So an important thing to note that the Fed hasn't really conveyed what would happen to the taper timeline in case data, uh, came out not as expected or lower. So all they've mentioned is that they may stop if they see surprises. So there's no particular number as to what that surprise would be. So, would it be considered inflation or would it be GDP or it is probably everything put together. But what is that threshold? No one really knows what that threshold is. Only they do. So that's something that is a cause for concern, and we really need to keep looking at the news and the development that's coming out of each country to at least understand what the central bank is expected to do. All right, so I'm going to move on to our next central bank, which is the Bank of Japan. Well, Kuroda has been, well, as I said, he's been very dovish. So when you say dovish, Kuroda is a perfect example of being very dovish as a central bank governor. All right, and someone who's very hawkish is the RBNZ governor, the Bank of New Zealand, so the Reserve Bank of New Zealand. All right, so if there was a statement that was passed yesterday, the best impact that the Bank of Japan could have would be the element of surprise. So they still feel that, okay, we can actually surprise these markets and push our currency lower or, in any way they feel fit. So they're looking at, if they were to do something drastic, it would come as a surprise to the market and no one would know where it came from. Because if markets are already expecting that something's going to happen, they would already price that in. But what the Bank of Japan's governor said that they'd like to use the element of surprise in their monetary policy. So that's not being very transparent, I would say. If you look at, they've been more or less pretty transparent, expected to do, but with the so if you're trading the Japanese yen, in your trades, you need to be careful of words that are coming out, or statements that are coming out of at least the Bank of Japan, or the main couple of guys in Bank of Japan. All right. They also mentioned that they're only halfway in achieving their 2% objective. The current inflation rate as of last month was 1.4%. So they're more than halfway crossed their 2% target. I would say they're about 70% there. So a lot of people again have not priced that into the yen as a currency. Now, if they were to stop their QE program, that would come as a huge surprise. But I wouldn't expect them to actually do that. I mean, to the surprise in this manner. I would expect them to surprise the market in the other manner, where they would expect the yen to even weaken. That's my expectation. Also, there was a sales tax hike, which dampened the effect of the QE, which happened a couple of months ago. That's also the reason why you're seeing 102, 103 rather than 106 and 107. This sales tax hike is expected to stay in the economy for a couple of years at least. So I would say that that this was not the best time for them to actually introduce a sales tax hike. They should have done it at a much later time, at least when their currency or at least inflation was closer to the 2% mark. But right now, they're probably going to have a much harder time to reaching their 2% mark. But overall, I think by sometime next year, mid next year, again, they'd be able to reach the 2% mark. As long as markets are stable and world economies are going at the same rate they're expected to go at. All right. Their current program is 6.8 trillion a month. Looks like they're going to continue to purchase the same quantity for at least another 2 quarters. There was talk of increasing this number to 7 trillion, but it hasn't happened yet, and I don't expect it to happen at least. There may be one bump up, but I think it's going to stop there. That's the max I would see from the Bank of Japan. All right. Everybody clear with the policies? All right. Okay, so I'm going to move on to the last. That's the Bank of England. Well, they also do have a very large QE program. Their current interest rates are 0.5%, and they've been there for the last 3 or 4 years. So, they've not really done much when it comes to standard monetary policy, reducing or increasing their interest rate. Um, but there has been a huge recovery, at least in the UK. When I say recovery, it's not just one or two sectors, it's all sectors put together. So I would say retail sales, inflation, GDP, everything put together. The UK is on a really strong road ahead. I would put them as in the 7 nations that I've covered. I would put the UK and New Zealand at the top of the table when it comes to their economy's performance. So, if you're looking at a very, very long-term trade and you're looking at getting the yields on your interest rate swap, these two currencies would be the currencies to pick for next year or even for this year, only in the beginning of this year. So GBP, against the US dollar, or GBP against, a very weak currency like the Japanese yen would be a great pair to choose to go long on, right? Because as long as the Bank of Japan continue their QE program and the Bank of England decide to taper, or their numbers came out fantastic today as well, so which bumped it up another percent today. So looking at these numbers alone, you'll understand which direction these currencies are going. All right. So I'd just like to also, the Bank of England, they're almost at their 2% inflation. They don't have a target as such if you compare them to the ECB or the US. They're pretty much happy with their inflation rate and it's going well. But they would like it to be above 2%. But they're the closest to 2% currently. Right. So I've covered most of the central banks. I'm not going to cover New Zealand dollar or the Canadian central bank. I think these four central banks, they move the markets in a pretty big way. So covering these four central banks would be more than enough for you to decide what you want to do in the long run. But before that, I'm almost about to finish. So if anybody has any questions about central bank policy or anything for that matter, I'm here to answer your questions. So it looks like everybody's clear, so I don't have any questions. Hawk means interest rate up. But yes, technically, if you're a hawkish governor, yes, interest rates eventually do go up. If you look at New Zealand, the Reserve Bank of New Zealand, yes, they are very hawkish and their interest rates are going up. But all right, I like the question Alexandra gave me. If you had a gun to your head and somebody says, enter a trade now, what trade would you trade? At this point in time, well, if someone gave me a trade to take in the next couple of hours, I probably wouldn't be able to take a trade. My trades are generally based on long-term trends. So if you told me, okay, you had a gun on my head for 24 hours, I'd say, okay, let's take a trade now. But looking at the price action that occurred today, GBP USD would be a clear trade to take on the long side. So I'll switch over to my GBP USD trade, and I'll draw a quick trend line. All right. So we're currently right about here. Okay. So if you look at this particular trend line, it's bounced off pretty well. It's crossed over a daily moving average, which is quite significant, which I use quite a lot. So, I would expect GBP to go at least all the way back to somewhere around these levels, somewhere around here at least. So 67, 6720, 6730 would be my first target. Maybe not making a new high, but at least these levels where you're seeing all these exhaustion candles, this would be around about here. Okay, so I got another question. I had a trend line on the chart, but didn't pull the trigger now. All right. So yeah, I mean, trend lines, they don't work to the dot. So it's important to keep a buffer of at least 5 to 10 bits. So, if I take my cursor and check, this particular trend line is at, say, 6457, and it touched 6463 or 64. So that's a 7 pip buffer. Yeah. So, I mean, if you're looking at a huge trend line from 11th November that's going on till 7, or today is what, 27th March, you're looking at a 4-month trend line. 5 or 10 pips shouldn't make a difference to you. If you're looking at the bigger picture, which you shouldn't be looking at 5 or 10 or even 20 pips here and there. As long as your direction's right, you should be booking on this particular trade. I wouldn't be booking less than at least 100. I mean, I didn't take this particular trade, but I had looked at the trend line today, and it looked clear enough as a signal for a buy. And it looks very clear to me even now. Like if I saw this yesterday, I'd be like, okay, let's see for another day. Yeah, so now it looks pretty clear from here on. So I don't see if there's a correction, maybe a 30 or 40 pip correction, that would be a good place to enter for a long of at least 100 pips. So I'd be saved. Sure. Anytime. Any other questions? All right, so looks like we have to wrap up. If interest up, inflation. Okay, I'll answer this question quickly. If interest rates are going up, no, actually inflation, well, it actually goes down. It's the opposite. So if you're looking at spurring economic development in a country, by bringing interest rates down, that would mean more money for businesses. Because if the interest rates are lower, I would like to take a loan from the bank. If I'm taking a loan from the bank for a business that I'd like to venture into, that would mean there's there are more industries that are doing the same thing. So that would mean if everything's going on well, you would see prices going higher, of everything. It's not only food or products and services that you use in your daily life. It's everything, vegetables or whatever. So yeah, it's actually the opposite. If interest rates go down, inflation is expected to go up. So that's why all the economies were actually trying to lower their interest rates to actually spur inflation. Where do you end today? All right. So, well, if you compare what Euro USD has done and what GBP USD has done today, I would expect it to stay around this level, 3770, 3780. I wouldn't expect it to go higher than this. There is a moving average just below this, the 50-day moving average, which I was looking at. It's not on this particular chart, but it's right there. It's probably at 3740. So I was hoping that it broke that, so it'd be a good short entry for Euro, but it hasn't done it yet. So unless it breaks it on the daily chart, I'm sitting flat on this trade. I haven't taken anything on Euro USD yet. All right, so looks like we have to wrap up. If anybody has any questions, you could email me at, I'll give you my email address. And that's my email address. Feel free to ask me any questions. I'd be more than happy to help you guys. Thank you so much for joining us, and I'll see you next month. Goodbye.